Hello and welcome back to Invest Like. Today we're diving into the strategies of Sir John Templeton, an investing legend who transformed a $10,000 investment into millions. Templeton's contrarian, often counterintuitive approach made him one of the greatest investors of his time. Unlike many investors, he looked for opportunities where others saw risks. In this video, we'll cover Templeton's 3 essential rules for smart, disciplined investing. Rule 1. Buy when there's maximum pessimism. Templeton was famous for saying, the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. What did he mean by this? When everyone is running away from an investment, Templeton would often lean in and buy. He saw downturns as opportunities to acquire assets at discounted prices, provided they were fundamentally sound. The idea is simple but hard to execute. Invest against the crowd. When a market or stock is crashing, it can be extremely tempting to follow the herd and sell off. But Templeton knew that during these times, assets were often undervalued. Think of it as buying quality items during a clearance sale while most are rushing to the exits. Practical tip: next time you see a significant market downturn, instead of panicking, evaluate if there's a long-term opportunity. Look for strong companies or assets that are undervalued simply due to market fear. Rule 2. Diversify globally. Templeton was an early advocate for global diversification, seeing international markets as an untapped goldmine. He knew that sticking to one market or region was limiting, as growth is constantly shifting around the world. By diversifying across global markets, he could spread risk and gain exposure to economies growing at different rates. For instance, while the US market might be experiencing a slowdown, emerging markets like China, India, or Brazil could be on a growth trajectory. Templeton believed that investors should never limit themselves geographically. A well-diversified portfolio with exposure to international assets provides a buffer against localized economic downturns and opens up new avenues for growth. Practical tip: look beyond your domestic market. Consider ETFs or mutual funds that focus on international assets to balance your portfolio. This way, you won't be overly reliant on the performance of a single country's economy. Rule 3. Avoid market fads and emotional investing. One of Templeton's core principles was to stay away from market fads and to keep emotions in check. He was always wary of investments that seemed too popular. In his view, when a particular sector or asset becomes the hot trend, prices often rise beyond intrinsic value due to emotional buying, which is risky. Whether it was tech in the 90s or crypto more recently, Templeton advised maintaining a skeptical outlook on overhyped assets. This approach involves understanding the difference between price and value. Many investors buy at the peak of a trend, only to suffer when the bubble bursts. Templeton's solution? Stay disciplined, focus on intrinsic value, and avoid decisions driven by hype or fear. Practical tip: before jumping into any trending investment, take a step back. Analyze the fundamentals, such as the company's revenue, profit, and long-term potential. Ask yourself, am I investing because I believe in the asset's value, or just because it's popular? Conclusion: John Templeton's disciplined and contrarian approach to investing remains highly relevant today. By buying in times of pessimism, diversifying across global markets, and avoiding emotional trends, you can develop a resilient strategy to weather both booms and downturns. Templeton didn't chase fads or trends, but instead relied on thorough research, a clear understanding of value, and immense patience. Thank you for watching Invest Like.